Another question that we have been asked by a number of users is how to calculate out-of-state taxes. There are two ways to do the calculation in XPouse. One is to use the actual tax paid. The other is to use the relative tax rate multiplier. I describe both methods here. To start this explanation, I'll set up a simple scenario in DeciMaster. In DeciMaster, we can enter a dollar amount for the other state's income taxes or use a multiplier. In this scenario, I will use a dollar amount of $5,000, which is 5% of the $100,000 taxable income for the father in this scenario. The case details are as follows. The custodial parent is mother. Her filing status is head of household with 3 dependent children, all qualifying for all of the child tax credits. She is a stay-at-home mum with no income. The non-custodial parent is father, lives in the other state. His filing status is single with no children. He has an annual wage income of $50,000, an annual other taxable income of $50,000, and an annual non-taxable income of $25,000. Health insurance annual payment of $3,000, timeshare of 30%, and the other state income tax rate of 5%. When we've completed the income and other child-related inputs, we enter $5,000 in the taxes on the taxes tab under the user calculated state tax amount. Once we have done this, the father's guideline net is $99,334. Note that in this example, we are using annual amounts and settings. I'm doing so as taxes are calculated on an annual basis, and if we use monthly values in the tax calculations, we would introduce rounding errors. To replicate this in XPouse, we enter the same income and child details as in DeciMaster for both parents. To enter a fixed state tax amount in XPouse, we look to the family code and note that taxes are a guideline deduction. Therefore, we enter $5,000 as an other guideline deduction and go to the tax settings and exclude the state income tax for California. And because we have wages income, we also need to exclude the state SDI. Once we have done that, we see that the father's guideline net is the same as in DeciMaster, that being $99,334 in this example. Although the above steps will work for all cases where the standard deduction is taken, we also need to cover the situation where itemized deductions are being taken. When we view the Form 1040 Schedule A, we see that for calculating the itemized deduction, we need to enter the larger of state income tax or state sales tax. In XPouse, in the detailed input window for miscellaneous tax deductions, there is an input for state sales tax. Under normal circumstances, XPouse calculates the state income taxes and compares these to the value entered for state sales tax and enters the larger to Schedule A. In the situation where we have an out-of-state tax amount and have excluded state taxes, we need to insert the larger of the other state's income tax or sales tax in this state sales tax field. In our example case, we don't have sales taxes, so we just need to enter the amount that we added as other guideline deductions for income tax. As I mentioned a moment ago, for cases where the standard deduction is being taken, it won't make any difference whether you make this additional adjustment. However, it is good practice to make this additional adjustment, as it ensures that you will cover any cases where the standard deduction and itemized deduction amounts are similar and may turn on this value being included. The other way to account for other state taxes is to use a multiplier. This is common to both disamaster and ex-spouse. In this approach, we compare the other state's tax rate to that of California's to calculate the value of the multiplier to use. To do so, first exclude all of the California credits and exemptions on the tax credit override window. On the settings screen, exclude guideline deductible spousal support. This is required to prevent spousal support payments clouding the calculation of the base income taxes. Enter the taxable income for the litigant from out of state. This can be wages or any combination of other taxable income. However, note that if using wages, a state SDI multiplier needs to be entered if the other state has such an equivalent. If not, then the SDI needs to be set to exclude, which I do for this example. Toggle the right-hand side of the ex-spouse screen to display the state income tax. On the right-hand side of the screen, toggle the display to state income tax, where we see that tax due is $5,339. The gross taxable income in this example is $100,000, made up of wages and other taxable income. The calculated effective California tax rate is therefore $5,339 divided by 100,000, which is 0.05339. The multiplier is the other state tax rate compared to that of California's, which is the other state's tax rate divided by the calculated California tax rate. In our case, the multiplier evaluates to 0.9365. We enter this value for the father as the out-of-state party under Taxes, Tax Settings, State Income Tax, and press OK. On the main screen at right, the total CA tax due now displays $5,000, which is exactly 5% as we wanted for the other state. We also see that the father's annual guideline net income is $99,334, which is identical to the guideline nets calculated by both disamaster and ex-spouse using a dollar amount for the other state taxes. You can now switch spousal support to include and toggle the B key to see the adjusted and unadjusted net incomes. The advantage of using the multiplier approach is that it allows using adjusted nets, whereas having a fixed dollar amount entered as the tax for the other state does not. Once you become familiar with ex-spouse, you'll find that the program is very flexible and can be adapted to handle most situations.